Hi there everyone, good morning and welcome to the market. I'm Avanne Dubash, with me Nikunj Dalmia as well as Anisha, Jain. And let's just put things into perspective because yesterday the markets sure kept us guessing. They changed their direction close to 9 times only to wrap up the trading day lower by about 72 points at 19,672. It was absolutely flat for the broader markets as well. So second straight day of losses, and you can see those jagged edges pretty evident in the intraday chart of the frontline index. That's the gift Nifty indicating that it could perhaps be a quiet start, but do remember that the Dow Jones has eked out its 11th consecutive session of gains. So the kind of handover that we've got from Wall Street is pretty strong, largely on the back of healthy earnings. So yeah, you had the small caps which continued to outperform, but Nikunj, like we said, we were kept guessing, and by the end of the day, it was a pretty choppy session and we ended in the red.
See, markets are either getting tired or they want to pause. And I think it is evident purely based on the price action, what we've seen, and in terms of how the positioning of the heavyweight is. And there is nothing wrong with it. Frankly, nobody is going to be complaining about the market setup in terms of where it is. If you do a good old comparison of global versus local, I guess global markets are strong, but there are two monitorables which you cannot ignore. One, dollar is at 101. Yes, sir. Dollar index is at 101, and crude prices have popped right back up to 83. So 75 has become 83, something which we cannot ignore. So I'm not saying that markets are about to reverse. I'm not saying that markets are going to fall. All I'm saying is that markets are slowly and gradually showing signs of fatigue, showing signs that inertia is just fading away. And even though I would continue to bat for the bulls, I would just say that we are reaching that patch where maybe bulls need a monsoon break.
A monsoon break, bulls definitely need that, and it looks like they are in mood of that given the fact that consolidation has been the name of the game. And then the big question is, where will the leadership come from? Because of course the likes of autos have seen massive run up this year already. ITC, the big trigger about the demerger is announced, and of course we saw how the stocks a bit of a sell-off on news yesterday. Reliance Industries, the big trigger which was there with respect to earnings as well as the demerger of the geofinancial price discovery, that has also played out. For HDFC Bank as well, the merger is done. The other banking numbers are also out. So Nikunj, that remains a big question, right? Which stock, which sector will now gain leadership?
No, let's look at that graph. I think it's an important graph simply because what it does is that it really captures the last 45 days of the market setup. And you want to stay with this graph right now. Why? Because ITC, well, the demerger has been announced. So the stock which has been an outperforming stock, the trigger is not there. For Reliance, well, the Geo Financial Service price discovery is done. So last week, Reliance and ITC, that potent combination of two heavyweights, they were doing tango. That factor is behind us. HDFC Bank and HDFC Limited, thank God the merger is done. So that mini re-rating, those concerns which were there, that is also over. Banks, including ICICI Bank, important numbers have already come out. So my limited point is that if you're looking at the index, where will the new trigger come from? Which is that next stock which will drive the market. So this market now needs a new leader. It was a combination of private banks, Reliance, ITC, which all of them had triggers to itself, and they are down. Today we will be done with L&T. And frankly, if you look at the contribution here, see, look at the contribution in this year. Large part of the contribution has come from ITC in this year itself. That trigger is out. ICICI Bank, I think good numbers, but it's not going to create any new upside momentum. L&T, the buyback announcement comes today. Results and the buyback announcement hopefully today. Reliance, including Geo Financial Services, the trigger is out, and HDFC Bank is 99 points, 100 points coming from there. That trigger is out. My limited point is, where is the next big trigger going to come from the market in terms of a leadership?
Yeah, and also, Nikunj, important to track what the strategy should be right now, because you're saying, okay, the bulls need that monsoon break. At one time, we were talking about 20K, but that now doesn't seem to be in sight. Are we fastening our seatbelts? Do we need to be picky and choosy? What's the strategy?
See, believe it or not, the markets globally and locally are hinging a lot on Fed outcome. Even though it's going to be an outcome that, okay, they're going to increase interest rates. But then markets are saying that if Fed is done with the increase rate cycle, what happens to the market setup? So that I think will be a talking point for next 2 or 3 days. I guess the best way to approach this market is that if you're long, and I'm talking about long leverage positions, time to reduce your positions. You need to take some commitment off the table. It's been a great summer rally. Well, the season has changed, so the strategy should also change. Summer is over, monsoons have started. So if the season has changed, then your strategy should also change. So I think it will not hurt you a lot if you start lightening some of your long positions. Similarly, don't sell your core portfolio. Got some delivery stock which you bought for 2 or 3 years, don't sell it. All I'm saying is that get out of your long positions and don't make fresh investments in small cap stocks. So cut your long positions, trim them out. B, don't sell your core portfolio, and C, don't make fresh investments in small cap stocks. My limited point is that we cannot call it summer rally of 2023. Summer is over. Monsoon has started. So if the season is over, your approach has to change also.
Well, yes, you'll have to change your strategy as the season changes and the market mood changes as well. And for now, the market is not in that roaring rally that we saw in summer. It's time for a bit of a pause, a bit of recalibration when it comes to your portfolio. And of course, because there are big cues lined up, of course, we have earnings to deal with. This week, almost 15 to 16 Nifty companies are reporting earnings. There's a lot of global earnings lined up as well, right from a Microsoft, Alphabet, etc. And then 13 central bank action. Of course, the top of the heap is, of course, what Nikunj alluded to, the Fed decision, but there are 13 central banks meeting. And of course, earnings, that remains in spotlight. And today as well, out of those 15, 5 will be reporting their numbers, right from auto majors like Bajaj Auto, Tata Motors. You also have L&T, wherein there are expectations are ripe for a buyback as well. Asian Paints as well, because of course, monsoon is going to be weak. What's the commentary going forward? That will be important. And then SBI Life, insurance, is it finally going to be out of the slumber or not? That's something to watch out for. But Nikunj, what's your take for the earnings season so far? Because it's been fairly in line or a bit muted. There hasn't been a big surprise that has come even from the banking names for that matter.
Yeah, so that's the point. Look, when the market rally started, you were way below the 5-year average. Now you're in line with the 5-year average. Earnings have not expanded the way which we thought. So earnings are okay, but they are not really contracting and they are not expanding, which means earning upgrade is unlikely to kick in. P expansion has already happened. So where will the trigger for the market come in from? It is going to be a function of liquidity. Now, calling the liquidity is always very, very difficult. You cannot judge the market solely dependent on liquidity. Please don't go and buy the market because FIs are buying. They may start selling also. So that, I think, is a false thesis to just ride your independent decision on because, okay, foreigners are buying, start buying it. No, sir, please don't do that. I've learned from experience that's the worst way to judge the market. But earnings, I think, will play a crucial role. Fortunately, there are no earnings downgrades. Unfortunately, there are no major upgrades. Tata Motors numbers would be important purely looking at the curiosity around it. Look at what happened to ITC. We'll talk about ITC, but I mean, the merger has gone through or the demerger has gone through. Nobody expected it, but the stock sold off because of buy the rumor and sell the news. Similarly, in earnings, Tata Motors also, since the performance in the stock has been so strong, all the HOS numbers and the whisper numbers are Tata Motor ka number acha aane wala hai. So they better deliver. That is the problem, because for stock which is up 60-65%, if everybody is talking,
are really riding
exactly.
high on this one.
So auto is one sector where it is not that the trajectory is changed 180 degree. There are incremental changes in business. There are incremental changes in margin. There are incremental changes in global demand. But the stock has taken a massive re-rating. This re-rating has to be justified with something more than what brokerages are expecting.
Okay, that's the entire earnings picture. But the other big talking point, as Nikunj said, is going to be ITC. And seems like the cat is really out of the bag because this news flow had been going on for quite some time with respect to the demerger of the hotel business. And now we've seen it's been one of the biggest contributors as well on a year-to-date basis. So lots of questions arising, Nikunj, in terms of what is next for ITC.
See, my view is that I know the stock sold off yesterday and that could be a function of profit booking or maybe some unhappiness in the kind of capital structure what they proposed in terms of, the hotel holding. My view is very simple. ITC has a cigarette business which is a cash generation business. That business has incubated the hotel business, the paper business and the FMCG business. Within the 4 businesses they have, ITC has now decided to demerge their hotel business. In terms of a capital structure, you may argue back and say that, okay, this is not the capital structure which everybody wanted because some share would be parked in the treasury. But that's how typically mergers happen. Demergers have happened in the past, whether it is Reliance or some other companies, shares do get parked in treasury. So I'm a bit surprised that why markets are really getting worried about it. Second, in this case, you're getting out a high capex business, and the future cash flows of ITC, now the FMCG business is also cash flow, will not be used. So the cyclicality in the business reduces because hotel is a cyclical business and the capex requirement reduces, which means ITC in my book should see what could be called as an P expansion, because if you're generating more cash flow and the cyclicality of the business reduces, I don't think it is something which is very large. See, let's look at the hotel business. Sum of part 20 lakh crore, 20,000 crore, not 20 lakh crore, 20,000 crore in the total market cap of ITC, sum of part, that's not even 10%. So in the overall scheme of things, it is important directionally, but it is not going to be something which is going to move the stock here and there. What we saw yesterday was this exaggerated reaction because the stock has outperformed massively. Yeah. So expectations were high, and good old classic adage, buy the rumor. So I think that was it. I don't think the capital structure is that bad. And frankly, if you get rid of cyclicality of a business, which is hotel, capex and cyclicality, they both go down, then FCA, which is future cash flow, it increases, and P expansion should happen. It is still very cheap, guys. We don't realize it.
Oh, well, yes, it's just that the stock has run up so massively that one wonders whether there's more upside on that as well. But the stock has proved time and again that, yes, it continues to beat expectation on a YTD basis, up 40% for ITC and very close to that 500 mark. But the market too was very close to that 20,000 mark. So are we headed back to that level? Let's try and decode that with our charters joining us on the show. Naresh Marani as well as Kunal Bothra, as always, with us. Good morning, gentlemen. Kunal, what's your view on the market? Yesterday it was very choppy. As Avanne was saying, there was 9 times that we changed directions. Any direction you want to call out for today?
Good morning. I would believe that we are at a cusp of a differentiated price action across the globe, because I was looking at the data that the Dow has, I think, hit one of the consecutive sessions, 10 plus sessions for itself on the positive side. But apparently the index has gone back into an extreme overbought territory, which means over the next 1 week, we could be expecting some sort of a cool off coming into that market. Now that has to trickle into other equity markets as well across the globe, especially our markets. We've already corrected more than 300 points, I think, if I'm not wrong, from 19,990 levels to 19,667 where we closed yesterday. So I think in that regards, we've gone through that first phase of correction. But this bounce back, if it happens on the index, would be a bit short-lived. So I would expect the index to cool off further, come back towards at least 19,500 levels. That could be a better support for the index. Since it's an expiry week, it is always very important to match up the open interest data. And for the Nifty futures, there was a dramatic change of open interest, almost a 40,000 of additional contracts added to the August series as compared to Bank Nifty, where the net numbers yesterday compared to July, August was a reduction of 10,000 contracts. That itself tells you that the inclination is more towards building slight short positions on the Nifty futures as compared to Bank Nifty.
Okay, let's find out what Naresh's take is then on the markets. Naresh, do you think that with now the next Q being what the US Fed could potentially do, the big earnings today, as well as the fact that it's been a very strong handover, that perhaps the undertone of the market continues to look strong?
So if you look at the small cap indices, they hit a new high yesterday as well. So the undertone has been bullish all through this period, even when we corrected from that recent highs of 19,600. Then now we are correcting from, say, roughly closer to 19,980. So the undertone has been bullish. We are seeing stock-specific moves as well as we are seeing sectoral rotations. So the view remains the same. We get into a pause on the Nifty, and there continues to be selective moves, some sectors doing well. And for the Nifty, the problem is, say, 13% of the index is IT, another 10% is Reliance. A lot of these heavyweights are still not in a strong uptrend. And even in cases where there has been a strong uptrend or a fresh breakout, the follow-up has not been great. So ICICI Bank hits a new all-time high above 960, but does not go towards 1,050, 1,100 quickly. So it's a slow and steady move. Consolidations is the part of the current move all through. That has been the characteristic of the move from 17,000. So for now, would expect 19,500, 19,600 to be a support. And that's the place where you want to look for index longs with a 100-pointer stop loss.
Okay, so there seems to be a bit of a consensus move that we are just going to hit a bit of a pause right now. 19,500, 600 is the kind of buying zone that you should be looking at. And of course, just to complete the point that Kunal was also saying, yes, Dow has been seeing an 11 session rally, and that's the longest rally that we have seen since February 2017. So quite a stellar one at that, but lots of earnings lined up this week. And back home as well, we have seen that the global fund selling had hit a 3-month high. So that FII point that Nikunj was also making stands true. But what about the stock specific action, and which are the top stocks on our chartist radar? Nuresh, tell us.
So the first stock would be a buy on NTPC. We are seeing a strong momentum across the power related space. We've seen the smaller names like NHPC, SJVN do well. NTPC is now just a point or two away from an all-time high. The stock is breaking out after consolidating, doing a retest of the recent supports. Expecting this to take a breakout move in the short term. A quick target price of 210 to start with, could go towards 240, 250 in the medium term. A stop loss at 193. Second is a buy on Hero MotoCorp. The stock has consolidated and made a flag pattern in the short term, which has a breakout about 3150, 3160 levels, which it tried yesterday. The longer term structure is 8 to 9 years of almost zero return, and then crossing 2950, 3000 has been a trend changing move. So expect this to slowly and steadily make new 52-week highs and all-time highs as well. So expecting a breakout move in the short term here. Stop loss at 3070 and a target price of 3500.
Okay, Hero MotoCorp is one of the buys coming in. What about you, Kunal?
So Hero MotoCorp is the first stock which I would suggest as a buy. Targets of 30 to 50, stop loss at 3080. I think after 5th of July, the stock has gone through a consolidation, and yesterday was the first sign of the stock coming out of that consolidation, forming a flag pattern. So would suggest a buy on the stock. And Balrampur Chini would be more of a conditional buy. The stock showed 3 days of slight uptick, but I think above 402 is where I would suggest a buy for Balrampur Chini. Keep that as a stop loss of 398 for a short-term target of 414.
Okay, Hero coming in as a consensus buy and then adding some sweetness with Balrampur Chini. But what are the stocks which are going to be in focus today? Well, OMCs is something that we are watching out for. As we alluded, the crude is back to those $83 per barrel mark. But what does it mean for the oil marketing companies in the stock? Samit will tell us all of that.
Well, off late, if you see, the oil marketing companies had run up a lot, and the main reason behind this was crude prices were on the lower side. Now, what happens is when crude is on the lower side, and if retail fuel prices like petrol and diesel prices don't change, and the gross marketing margin of this oil marketing companies increases. Now, because of the sudden rise in crude oil prices, if you see the gross marketing margin that oil marketing companies earn on selling every liter of petrol and diesel, that is actually half. Now, at the end of June, on petrol they were earning a margin of around 13.7 rupees, which has now come down to around 6 rupees per liter, while on diesel it has come down from 9.1 rupees per liter at the end of June to around 2.1 rupees per liter. Now, this current amount of 6 and 2.1 rupees per liter is also higher than the previous averages, but still it has halved from what they were earning just a month back. Now, if crude oil prices continue to remain at this level, and if going ahead oil marketing companies are asked to cut petrol and diesel prices, then it would be a big concern for these oil marketing companies. And the recent run up also we had seen basically on the back of this. But there's also a positive point on this front, and the fact is that refining margins are gaining. But the negatives are going to weigh more on the oil marketing companies at this moment. That is what we understand. But what do you understand, sir?
See, Samit, my point is that why do you want to whistle in the dark? These are great companies. You need those companies. But those companies, in a sense, are not really allowed to maximize profits when the timing is good, and they are arm twisted to take the losses when the timing is bad. Now, you cannot invest in a business where you cannot have a fair play.
Right.
Now, when you don't have a fair play, the whole argument of value, I think, is something which gets defeated. Value is something when you invest in something which is cheap and the market discovers the value. But if the template of business, which is when the scenario is good, you make money. When the scenario is bad, you lose money. If that template itself is tinkered with for whatever compulsions of the government are, then the value of that stock will never be discovered. So these are stocks where you would say, okay, do you need fuel pumps? Of course you need fuel pumps. Do you need, are fuel pumps migrating and are they putting electric vehicle charging stations there? Of course they are. Do fuel pumps are migrating and are they putting energy CNG stations there? Of course they are. But the point is that the basic template where the profitability in a good time is challenged and the losses are magnified, you cannot invest in that business. There is a reason why, even though these are businesses which have a moat around them, India had HPCL, BPCL and IOC till the time IHB was merged with IOC. It's a monopoly which the government currently has, yet these businesses never get P multiples which are even north of 10.
Right.
Because you know the answer now. So why to go and aim on something when rest of the market is so nice?
Right.
Why to go for these 3-4 stocks again and again? They are cheap, they will remain cheap, they're cheap for a reason.
Yeah, why to throw that dart in the dark? Because these businesses have had the inherent
Dart in the
challenge.
dark will still get you a probability of getting a bullseye.
Yeah.
I mean, probability. But with these, I mean, if you're investing in them with your eyes open, you could ask yourself that for what, I mean, is there a compulsion for you to invest in them?
Yeah, there's so much just choice available. Why would you go for something which has so many regulatory overhang and just before elections, which are there next year?
No,
you
there are
might
state
not
elections coming. Chhattisgarh,
Yeah, of course,
Rajasthan,
state
there
elections
is.
and then the
From
central
November, I
elections.
guess the election
Exactly.
period is starting.
Correct. So yes, with lots of those things lined up, would you want to bet on an OMC or not? But would you want to bet on a capital goods major ahead of election, because at least that sees a lot of tailwind around that? L&T is the stock that we have on our radar. Of course, the company will come out with its earnings later today. So we'll watch out for the fact how the growth is likely to be, because for now, we're expecting a 14% growth on the top line. The profitability is expected to jump up by 26%. But the big question is, how does the order inflow pan out, and how does the the guidance for the year pans out? Because remember, for now, they're talking about 12 to 15% growth in terms of revenue and order inflows uptick of around 10 to 12%. And of course, the big kicker in terms of the buyback is what we're expecting. Jain Financial, for instance, expected the buyback to be around 10,000. There are other analysts as well, which have a number close to 15,000 penciled in. Nikunj, what do you think about this one? Buyback, of course, could be the near-term trigger, but what about the long-term prospects?
See, if there is one clean play which is still available, very cheap, which is a bet on India, I think it's L&T. And we always tend to think L&T is construction and L&T is defense, but there is an IT business which L&T has incubated very smartly. We know that they're looking at restructuring their subsidiary L&T Finance also. A new nominee has come in. So L&T is now moving wherever they can in terms of getting efficiency. And I think that is something which, Mahindra and Mahindra tried, or when Chandra came in, he fixed this business of Tata Group per se. When Anish came in, he fixed the capital allocation for Mahindra per se. Is L&T looking at fixing some of their basic issues of capital allocation? The answer to that is yes. The fact that you're considering a buyback is that you want to see if you have cash on your balance sheet. It will have impact on your return ratios. When you're giving cash back in forms of buyback, you essentially shoring up the return ratios. This is for me a clear indication that the management now is thinking in favor of shareholders rather than taking those emotional calls with some of the IT companies and corporate India has taken in the past, that cash, we'll hold cash to a chest. Bad times, kya pata kya ho jaye. No, now it's a reasonable assessment and confidence which is giving them this belief that cash can be given back. Why are you giving cash back? Because you're simply feeling confident. And if I look at the credit offtake from banks, especially the capex corporate credit offtake, it's strong. If the credit offtake is strong, a business like L&T definitely will be in a good shape.
Yeah.
Also, one more thing positive for L&T working here is the fact that crude is now stabilizing around the $80 per barrel mark. They have a good business
should
coming in from Middle East. So hydrocarbon business could also benefit for them.
Okay, interesting tailwinds, and we'll wait back for the management commentary later this evening. L&T will be reporting numbers, and buyback is on our radar as well. But a whole host of other earnings were reported last evening as well. It was a good set from the likes of Spandana Spurti, Aarti Surfactants, a bit of a weak set for DCM Shriram, but then there were a lot of in-betweens, the likes of Shoppers Stop, JK Paper and Tata Steel as well, which managed to report a mixed set of numbers because the India performance was quite strong, but Europe was a bit skittish. Let's go across to Anisha to get the internals of Tata Steel.
Well, yes, largely inline set of numbers from Tata Steel this time. European operations continue to be a pain point. European EBITDA per ton has come in at a loss of negative $96 per ton versus negative $95 per ton that the company had reported in the previous quarter. Lower volumes, global macroeconomic concerns is why Europe continues to be a concern for the last several quarters. India operations meanwhile stood out. Volumes were on the lower side, but net realizations were on the higher side, and hence EBITDA per ton declined by a marginal 2.5% on a quarter-on-quarter basis. Meanwhile, company incurred a capex because of which net debt has risen from nearly 67,500 crores to about 71,500 crores, and that is a bit of a concern. In fact, we have a couple of brokerage notes that have come in. First up, let's talk about CLSA. which has maintained its outperform stance on the stock with a target price of 125. They say results were largely in line. Adjusted EBITDA was driven by income from long-term lease agreements with Tata BlueScope. Morgan Stanley, meanwhile, has maintained its equal weight stance on the stock with a target price of 110. They say standalone EBITDA was slightly ahead of estimates on account of better realizations that the company enjoyed in the quarter gone by. European operations could remain overhang in the near term. All in all, numbers were in line. Net debt has risen, which could be a concern. Brokerages are concerned about European operations and the fate of UK business, which depends upon the support that the company will receive from the UK government.
Thanks, Anisha, for that. We'll watch out for Tata Steel. But overall, ESG is an interesting space, and that's the word coming in from Ravi Lamba, the head investment group head, India, Temasek. Listen into what else he had to say about the new sustainable and tech-related opportunities that they are spotting in the Indian markets right now.
As an interesting space. We have a renewables platform called O2, which is progressing quite well in renewable energy. We have deployed many strategies globally on decarbonization and energy transition. So if I think about the next phase, I think ESG will be a big component of that. The digitization story in India has been phenomenal. There have been some great outcomes from UPI as an interface. We've seen ONDC as another platform that's rising, and these all they're firsts in the world. We don't see them elsewhere, and we see opportunities coming out of that. So a lot of our tech businesses that we've invested in are benefiting from that, and we see that as a trend to continue. In 2022, we saw the opportunity set rising. We could put more capital to work, so we kind of doubled that run rate. We're now looking potentially at doing more than that if we can find the right opportunity. So it's a big if. But if we can, we could invest $9 to $10 billion over the next 3 years in India. That's kind of how we're thinking about the opportunity set. Future of consumption, longer lifespans, digitization, and sustainable living. So if I think about those four and I think about where India is positioned, we find opportunities across the board. For example, in the future of consumption, we have investments in various aspects of the consumption chain. So that could be financial services, technology, healthcare, pharmaceuticals, etc.
Okay, so those were some of the mega trends that the market needs to watch out for, but you need to watch out for a lot of stock-specific action today as well. Let's try and decode that with our chartist again. Naresh, yesterday the big theme to watch out for, of course, was the power sector, whether it was SJVN, NHPC, the financiers, REC, PFC, and today there's the positive news also on Power Grid as well as SJVN, wherein there have been allotted more projects going forward. Do you think this is a very interesting space to be in?
So I've been bullish on the whole NTPC, Power Grid, and the whole power pack for some time. We covered NHPC last week as well in Chartbusters. So if you look at the sector has gone through a period of almost zero return for a long period of time. So if you look at NHPC, the stock had listed back in 2009. It was at 38, 35, 40 rupees. And all through the last 10 years, the returns 10 to 13 years came only from dividends. Now, finally, that has changed. Over the last 1 year, last year it gave a breakout of all those 38 mark. That was the start of a new trend. Same is the case with SJVN, same is the case with other smaller power names. So out here, this is a trend which could continue towards higher levels slowly and steadily. Interesting is the case, same is the case with Power Grid, which has gone nowhere. But this is a company where finally we've also seen shareholding changes. 32% of the ownership is with FIIs, unlike the case with in many PSEs. So overall, the structure is a long-term uptrend which has started, slow and steadily would continue. And over the last 1 year, clear outperformance. So last 1 year back, we saw a gap down on Power Grid, wherein there was rumor of them taking REC. From that point of time, REC is also up 50-60%. And you have a 30% move even on Power Grid. So the trend is strong. As of now, the best pick right now is NTPC, which is just say a couple of points away from a fresh 52-week high, and on a dividend-adjusted basis, an all-time high. So NTPC, NHPC, Power Grid still look promising at current levels.
Okay, let's move on then and hear it out from Sanjeev Bhasin as he shares some of his top fundamental stock ideas. He's betting on Pyramal Pharma. Listen in.
I gave this game plan that the stock corrected from 200. The original business of the Pyramals was actually pharma. They sold their blockbuster dust to Abbott, and then they got into real estate. On the API and on the contract farming, they're doing extremely well. The numbers are belying that. Let me also give you a disclosure. The Pyramals have issued warrants at 127. So I think 127 is a minimum threshold which is coming. We'll wait for quarterly results, but Pharma is coming back very, very strongly, and Pyramal takes the cake. So don't underestimate the group, because I think the worst may be over when the demerger and the other over leverage was there. Now the numbers are showing you extreme strength. And as a disclosure, from 72 levels, we have a lot of position in that, both for our clients and personally. And I will not sell this stock till 150.
Okay, Pyramal Pharma is one stock that you need to have on your radar. But back with earnings, it was Spandana Spurti that reported a growth of almost 4% on a sequential basis when it comes to their asset under management. The NIMs too have come in at around 14%. How does it stack up versus the expectation? And what does the street decision seem to be about this company? Let's go across to Vamakshi to get that sense. Vamakshi?
Strong set is what Spandana Spurti has reported this time around. Let's first look at how their AUM has panned out. AUM has come in at 8,848 crores, which is an uptick of almost 60.5% coming in on a year-on-year basis. It is also up nearly 4% on a sequential basis. Now, disbursements are also seeing a healthy uptick, coming in at 1,664, an uptick of almost 26% is what they've reported on a year-on-year basis. But sequentially, yes, disbursements are down, and that is mainly on account of seasonality factors. But the positive is that the customer addition has been quite strong. Now we also saw that there was a sequential surge in yields because the company is continuing to enjoy pricing power given its unique customer base. NIMs came in at 14.2% versus 9.9%, so significant improvement as far as NIMs are concerned, both on a year-on-year basis as well as a sequential basis. Net interest income as a result came in nearly more than double, at coming in at 293 crores. PPOP, that is pre-provisioning operating profit, given the kind of cost rationalization that the company is doing, also came in much higher, and the company in fact reported a net profit of 119 crores, and PAT in fact has sustained over the 100 crore mark for the second consecutive quarter for as far as Spandana Spurti is concerned. Not just that, the asset quality was also quite robust. We saw an improvement as far as GNPA is concerned. It did see an improvement from 2.07% to 1.63%. NNPA also came in at 0.49%, and with this the credit cost has also moderated to a normalized level of nearly 1.5%. Now, in the con call, the management also highlighted quite strong outlook. They expect to attain AUM of nearly 10,000 crores by the second quarter, and 11,750 to nearly 12,000 crores by the end of this financial year. They have highlighted that the credit demand is very strong, and from the quality point of view, there has been a marked improvement. They're also progressing quite well as far as their Vision 2025 is concerned, and NIMs have further scope to expand due to residual repricing of portfolio and likely moderation in the cost of funds. So largely, all in all, it looks like a very strong set from Spandana Spurti. Good commentary, and that is the reason why you should watch out for this counter.
We'll certainly be keeping that stock on our radar, but let's move right on then. And speaking at the 164th Income Tax Day celebrations, the Finance Minister Nirmala Sitharaman said that as many as 1 lakh notices have been sent by the Income Tax Department to tap into undeclared or underreported cases of income. The department is set to complete the said notices filed 4 to 6 years earlier. That will be completed by the 31st of March 2024. Let's hear out that excerpt.
This change was also made only about 2 to 3 years ago, 22, I think, if I remember correct. We brought it in saying it can't be that somebody has to sit with his tax records for full 10 years. So that change was brought out, and even there, it cannot be done randomly by somebody. A principal chief commissioner will have to give the permission to reopen. These changes were consciously brought in for the benefit of tax assessees. Even now, there are observers of Indian economy who say that there can be a widening of the tax net. Even today, the widening is an issue about which we are talking. What will work? Nudge will work. Campaigns will work. That if it is above board and assessments are done, that is why the TCS and the TDS are always talked about. They are not newer additional taxes. Just track and trace. And therefore, there is a need for all of us to look at Indian economy and see how best we can contribute towards building a developed India by 2047.
now to discuss some of the stocks and how do the fundamentals stack up. Pankaj Pandey, the head of research at ICICIdirect.com, joins us on the show. Pankaj, let's start with ITC itself. What are you making of the merger? A bit disappointed by the complicated structure or the fact that the news is finally out? That is something to watch out for.
So, hi, good morning. Thanks for having me. I think this demerger is a bit of a sort of a disappointment, largely because a vertical split would have been a lot more better from an investor perspective. But I think from a per share perspective, hotel business was contributing over 25 rupees. So probably from a number perspective, it does not really sort of matter much. But I think overall, it's a bit of a disappointment because you're still holding at 40%, and it is very much possible going forward that this business will require money, and capital allocation could remain the challenge which has been there for a good period of time. And so from that perspective, yes, it's a bit of a disappointment, and I don't think we'll be sort of raising our target prices because of that. Bit of a letdown in terms of expectation.
Pankaj, what about the outlook when it comes to the entire metal sector, owing to the fact that you have seen a bit of a decline that has set in? What's the outlook on where you see metal stocks headed?
So I think on metals, we still don't have a very clear trajectory in terms of how China will sort of perform. So while you see the volume growth being good, especially on the domestic side, whether it is for Tata Steel or for JSW Steel, I think the pricing is a sort of a challenge, so which is where I think things are yet not clear. And Chinese rebound in the economy is still sort of soft. While you will get benefit of lower coking coal prices from Q2 onwards, so that will sort of lift the overall EBITDA per ton. But our sense is that metal still, as an overall space, we would want to sort of avoid, given the fact that we don't have a clear trajectory in terms of prices. So despite attractive valuations, I think probably it is still not an opportune time to sort of dabble in metal as an overall pack.
Might not be a good time to dabble in the metal stocks for a bit of a medium to long term, but for the day we might see a bit of rebound in some of the metal names. Of course, for the last 5 days we have seen that these stocks have been on the back foot, but of course today it's the Asian market which has been doing quite well. Hang Seng is up over 3-4%, and that after China said that they're looking at supporting the ailing property market, and that usually means good news for some of these metal names as well. But separately, Naresh, if I can get a technical view on some of these metal stocks.
So metals as a basket has done, say, sideways to moves to downward moves in some names and an uptrend in some of the other names. So, for example, if you look at Jindal Steel, the stock is say at 630 odd levels. The all-time highs recently made was 650. 600 was the high previously back in 2023, as well as 570, 580 was in the previous cycle. So you have a Jindal Steel which is doing well. You have a JSW Steel which is doing well. And then you have a Tata Steel which has gone nowhere. So out here the case is stock specific different moves. You have SAIL which is still down 40% from the previous cycle highs done. So out here one has to be very, very stock specific. So the only name which still looks trending up is Jindal Steel. Till the time it holds about 600, you want to buy on a retest of 610 to 620 levels and keep a stop loss at 600. So out of all the names, only Jindal Steel comes in the trending basket.
Okay, so that's the take coming in. But Pankaj, just wanted your view regarding Shoppers Stop as well. The company came out with its earnings, and no surprise that it was another tepid set. The revenue was up around 4%, but the margin performance was better than street expectation. Do you think this weakness about the apparel business sale is likely to continue and not the best time to dabble into these names as well?
Well, yes, I think numbers were a bit soft for Shoppers Stop, largely because when you sort of look at the overall share of private label, that is intact at about 14%. Now, the challenge is that the companies have been offering higher discount because the overall sales have been tepid. And that, along with that, there has been a store addition, so that sort of impacted margins. I think we are yet to sort of see a revival in the overall retail sales. So I think that remains a sort of a challenge in the near term. But structurally, I think we like the retail space as a overall, and I think if Shoppers Stop is able to sort of increase the proportion of private labels, which is a high margin business, I think things will look a lot more better going forward. But near term, we don't see much of a price movement given the results.
Okay, that's the view coming in on the retail space. But time to move on then to stocks on the editor's radar. Today, we're discussing the auto stocks in great detail. Well, we have seen a pretty strong move already on a year-to-date basis. There's been an up move of about 24%, and all eyes will be, of course, on results and the likes of Tata Motors, given the fact that, you know, the chip supply shortage issues seem to have been behind us, etc. There's a lot riding in terms of expectations.
Look, I mean, the auto sector has seen its best first 6 months in last 9-10 years. So obviously it is turning out to be the sector of the year. What has changed for autos? I think somewhere they did not participate in the post-COVID rally. Margin concerns were there in 2021, and in general the industry suffered because of semiconductor problems. And the global companies, they had the issues largely because the European economy last year, because of what happened to Ukraine and what happened in Russia and Ukraine, was in some kind of in flux. Tata Motors numbers are due. Now everybody would be monitoring these three things: JLR performance, free cash flow and margins. On free cash flow, they've already given a guidance, so you know which way things are moving. JLR performance, you know that it's incrementally getting better because you get the auto dispatch number. This is the surprise. So if you're looking at the stock now, the surprise element really has to come from the margin front, and also what is really happening to the domestic CV business, because that's where they've lost market share both in the CV market and in the HCV market. So I think Tata Motor will be remembered as a classic turnaround story. But if you're a near-term investor, you got to ask yourself what's next. You know, this what's next, I think, is the most important thing you got to ask yourself every time when you're looking at the numbers. These are the expectations, both sequentially as well as quarter on quarter. But for me, the monitorable here would be JLR margins and what happens to the CV business. We don't talk about it. CV business and what is happening there. Cash flows becoming better, JLR becoming cash flow positive, company migrating towards becoming a net debt. The Tatas, I think, have done a great job in turning around Tata Motors. I'm not taking that away. But in the near term, when you're looking at a stock, especially in terms of positioning, extremely overbought, little bit of disappointment could backfire like it did in a lot of other cases.
Okay, so CV business is going to be critical as our margins, Anisha, when it comes to Tata Motors.
Well, yes, and Nikunj, you're right. Yesterday, TVS reported a largely in line to a slight better than expected numbers, but it saw a bit of a sell-off after the run-up. Will it be the case with Tata Motors today? Pankaj, what's your view?
So I think when you sort of look at Ashok Leyland numbers, the CV margins were quite good, 10%. Our sense is that most of the players on the CV side are reporting healthy margins because of the good pricing discipline, and also the product profile is tilted towards the heavier tonnage, and that is leading to better ASPs. And I think Tata Motors overall, our sense is that will deliver double-digit kind of numbers on the CV margin side. So that I think is a key positive. And I think one more concern was in terms of how the overall capex will pan out, especially on the battery side. So that way, I think with promoter pitching in, I think so that worry is also sort of put to rest. So I think overall they've been firing cylinders in most of their businesses. CV was one lagging piece, and I think last 2 quarters we have seen a revival there. So we are positive on this company. We have a target price of 700 on the stock.
I'm going to put this graphic out, which talks about what's next, the leadership part. For Reliance, the demerger or the price discovery of Jio is done. ITC, the hotel demerger trigger has been played out. For ICICI Bank, results are already out, and for HDFC Bank, the merger has gone through. So Pankaj, which would be the leadership stock now? Because clearly for the 4 names I mentioned, the heavyweights, all the triggers have been played out. What's next? Who will be the new leader?
So I think, Nikunj, banking is still one sector which will continue to do well. I think first quarter, there was an expectation, or first half, there is an expectation that the NIMs might be soft on a quarter-on-quarter basis. But our sense is that overall in the second half, things will recover. And lastly, so NIM sort of contracting probably may not really play out for this year. So you'll see subdued in the first half, but recovery in the second half because of the MCLR benefit. And I think banking, we are still getting good amount of inflows. So banking obviously is one of the pockets which can sort of do the heavy lifting. And I think Reliance, probably our sense is that while retail and even the geo businesses sort of okay in terms of performance, but I think overall our sense is that probably the petrochemical business could do better going forward, largely because some of the input cost pressures might sort of go off. So I think, and then I think IT hasn't sort of, or IT may not really sort of find the triggers from earning perspective. But we have Fed meeting lined up, and if Fed is comfortable not really sort of hiking beyond the current expectation, then I think the macroeconomic scenario might improve, and the overall deals might get converted into revenues in the second half. So that there could be an element of positive surprise. And I think autos continue to sort of do well. So I think overall, our sense is that some of these pockets will sort of continue to fire for the market. And which is why we feel that 21,400 is very much on the cards going forward.
Wow, by mistake, nonetheless, you said 24,000 on the Nifty and our ears popped, but at least we'll be fine with 21,400 as well. But Pankaj, I'm not sure if you track Jubilant FoodWorks because the company reports its numbers today. Wanted to get a sense from you as to what should one expect there, because on one hand, the footfalls, etc. have been improving, but the cost pressures with respect to cheese and others as well continue to be quite high.
So we don't have a coverage on this stock, so I'll not be able to comment. But yes, you are right that the input cost pressures have been impacting margins. And I think that is still not sort of changing. We are still seeing some of these input cost being at elevated levels. So I think the stock hasn't done much. We really do not expect any near-term sort of big pop-up in the stock going forward as well.
While Jubilant FoodWorks is struggling because of cheese prices, then it reminds me of this famous book, Who Moved My Cheese? That's really the story for something like Jubilant FoodWorks. But Zomato, on the other hand, is just going from strength to strength. And Naresh, yes, no, yes, no. A lot of folks said, I don't know. Now everyone is saying, we love Zomato.
So the stock has gone through that cycle of being highly looked at in the news all the time at 150 levels, and post that it went through a cycle of nobody being interested, went through a 12-month period of almost zero return consolidation, and now the trend has changed. So from that 50-55 mark where the breakout took place, the stock is facing that resistance around 80 mark, which is where it topped out in 2022 to 23. So this pause around this 75-80 mark is normal, and overall after this pause we could ideally go towards 100 as well. So out here now 70 should become the new base, and one should be looking at a dip zone to 75 to 80 to be an accumulate. The trend has started. We'll continue to see pauses here, and it could surprise on the way up because it's making a classical formation of bottoming out, and this is how it goes. We've seen this happen with the PB Fintech, which continue to do well. A very similar formation here, and a lot of these new age names, and we've seen much higher moves in say Nasdaq names which had a similar structure. So out here the view is 75 to 80 is the buy zone. Keep a stop below 70. Expect a move towards 100, and then look at it again at 100, 110 to review.
We'll come right back to charts, but in the meantime, let's find out how some of the top and ace investors are rejigging their portfolios. It'll be interesting to find out which stocks have made it and which stocks they're selling. So let's find out their smart portfolios. We've got Sharad here with the details. Sharad, who are we talking about today?
Well, today we are talking about two ace investors, Dolly Khanna and Sunil Singhania. Firstly, we'll point out Dolly Singhania, and over here there has been no new entries as such, but the overall stake has actually reduced below the 1%, and this is Ajanta Soya. So overall, this company is actually dealing in the edible oil segment. Now let's look at the key segments where actually the change has actually increased in Pondy Oxides. It's a small cap company, PVC additives, strong growth opportunities are expected as dealers have suggested, and also Deepak Spinners over here, the spinning companies have had correction and they have reported production losses as well. So over here also the stake has increased by almost 49 basis points, and Talbros Automotive is in focus. The stock has been on a strong rally on capex plans, and also the company is considering a share split. So over here these three are the stocks where the most number of shareholding upgrade has actually happened, if you have seen from the March quarter. Up next, we are having Sunil Singhania. Over here, there no new entries have been reported yet, but two important exits are there where the stake might have gone below the 1%. And we have two companies, Traxon Tech, which was recently listed, and the company itself deals in data science and also has a lot of data in the private equity space. But the stock has been in a correction mode. And also Mastech, that is something which the IT companies have been under pressure, but the company itself has been pivoting to non-US markets and expecting more orders in the front, especially from the UK front. So this is something which we would like to watch out for, and slight increase in the portfolio coming in for HIL, IFL Securities and Dynamit Tech for Sunil Singhania.
Okay, thanks very much for giving us those details. Those are some of the interesting portfolio rejig stories that Sharad is flagging off. In the meantime, in yesterday's trading session, you did have the small cap index, which managed to outperform, albeit very marginally. And some of the names that really stood out within the broader universe include the likes of an Aarti Drugs. You had a Canfin Homes that had a pretty terrific run up. Glenmark, for instance, was in the limelight on the upside, and BHEL was up about 3.7%. Kunal, let's get in your take. Any of these stocks standing out?
So BHL, of course, is one of the stocks which we've been recommending earlier for a potential target of 100 plus from the time of I think 80-81 odd rupees. Now I think closer to 98. The stock closed at 98 levels yesterday, so which means we are now in touching distance of breaking past about the levels of 100. So I would expect the momentum to continue as well as built up for BHEL. Would continue to have a bullish stance over here. Glenmark Pharma on the other hand, in fact I was looking at the charts yesterday and at a closing of 780, 785, it's now entering into a deep overbought territory. So my sense is that the stock may probably try and have a touch and go movement towards the 800 levels, but that could actually be a zone where it may hit its peak of resistance. So I would not be too much interested to buying the stock at current levels. In fact, I think closer to 800 levels is where would look to book out profits on Glenmark Pharma, and then wait out for a sizable correction. Because of the way the overbought nature of indicators pan out, we expect ideally a 10% odd correction into the stock price. So maybe if it comes back towards 720, 730 mark, that could be a zone to buy back again.
Well, the breakdown stock yesterday was AU Small Finance Bank. Their cost of liability has gone higher. But is it one of those stocks which can it bounce back? It has bounced back in the past when all the concerns were raised about the NIMs and what will happen to AU Finance, Small Finance Bank during NBFC crisis. They came out very well. Is AU Small Finance Bank a good buy, Pankaj, according to you?
But when you sort of look at the smaller BFSI play, then we like a couple of names. So one of them is obviously Credit Access Grameen. I think growth was a good positive surprise there. Then I think we have started liking Shriram Finance. I think we are looking at CVs doing particularly well going forward, and this company is one of the major players on the used CV plus the new CV side, with 80% of the portfolio aligned on that side. So that is another, and then we continue to like both M&M Finance and L&T Finance, given the fact that especially L&T Finance, the focus on retail is quite high. So I think so. These are some of the names what we have been liking in the tier 2 BFSI as a space.
Okay, what about your thoughts on the OMCs now with the Brent close to 83, Pankaj? How are you looking at the impact on some of these stocks, the likes of Chennai Petro, IOC, BPCL, etc.?
So Chennai Petro, the GRMs are softer. While the Singapore GRMs itself are soft at around $4. So they've come at around closer to 8.4 or 8.5, if I recollect it right. So the premium overall has been sort of shrinking. But I think OMCs overall, we like the tier 1 names like IOC. I think our sense is that some of these companies are looking to sort of up the green capex on the green hydrogen, ammonia, and a number of other perspectives. So valuation-wise, all of them are sort of quite attractive with the decent dividend yields. So our sense is this is one space which has been sort of ignored, and going forward, one can expect a lot more exciting things to sort of happen, and which is why I feel that IOC looks particularly attractive within the overall downstream companies.
All right, tell you what, we'll slip into a very quick break, but come right back. We'll be connecting with Abneesh Roy as we talk about the outlook for ITC, what disappointed shareholders yesterday, and what lies ahead for the company.
ITC, that was the stock of yesterday. Will it be the stock of today? And what is the brokerage community making of the demerger which has been announced? Abneesh Roy joins us to talk to us about all of that. Hi Abneesh, good morning. What's your sense with respect to this demerger? The structure, is it coming as a bit of a disappointment?
Yeah, thanks. No, the structure is not at all a disappointment. This structure is the best structure. This will allow that ITC Hotels continues to get synergy benefit from the overall group. If you see, they do have back-end sourcing, for example, from agri. Similarly, in the foods business, if you see clearly the R&D and the expertise which the foods business has, and again, very good synergy benefit with ITC Hotels food business. So those things will continue. If they had made a 0% holding, then obviously this would have become a takeover candidate, and then there would have been no control. So this is the best structure wherein the synergy benefit is there, the stability is there, and definitely the key concern which ITC stakeholders had, that this was a cash guzzling business with 20-22% of the capital getting allocated here. But in terms of revenue and profit, it was below 5% and return ratio also in single digit. So that concern also goes away. So I would say this is the best structure. And definitely in the next 12 to 14 months or 16 months, when the ITC Hotels business also lists separately post all approval, I think investors will appreciate that this was the best structure in terms of taxes, in terms of the stamp duty, in terms of everything. This was the best structure. Having 0% or having 51%, that would not have been the ideal structure. So 40% is a good one, because the current shareholders of ITC continue to hold 100% stake in hotel business even after listing, because 60% will be direct listing and 40% will be via the ITC. So 40% is getting you all the tick marks in terms of all the above reasons. So right.
Do you expect that there could be royalty which now ITC could be charging from the hotel business? Because if you are giving the brand ITC Hotels to a subsidiary where you don't have more than 50% stake, technically you can command that royalty for brand usage, the Welcome Group brands, the ITC, all the other famous brands they have in terms of hospitality?
I think that's a fair question. Normally, we do see that this kind of a royalty structure is there. For example, in Britannia, Wardias charge royalty. Similarly, in case of all the multinational companies also, there is a royalty aspect. So we'll get more clarity on these when we have the con call in the next few days. And also on 14th of August, there is the final board meeting, and we'll have more clarity on the market cap and the number of shares, etc. But that assumption, I think it's a valid question that there could be royalty. They have many brands. So obviously, wherever ITC brand is there, there could be a royalty. That clarity we would await in terms of the con call which will be held.
Now, Abneesh, if I look at a slightly longer term time frame for ITC, could this be a PE re-rating moment for ITC? Because cigarette business is generating cash, FMCG is free cash flow positive, and hotel business, which was the guzzler, no longer will take capex, which means there could be a marked improvement on return on equity and return of assets for ITC.
Yeah, absolutely. We have the same view. In fact, that's why we have ITC among our top picks for a very long time. So yes, in this annual report which has come out FY23, again ITC has clearly shown that a rational tax policy is the best for the government, best for the consumer, and best for the overall industry also. So we have seen clearly market share gains by the legal cigarette players, and this year also it's continuing. That's why in Q1 also we expect a healthy cigarette volume growth. If you see even Hindustan Unilever, which is a FMCG staples company, has seen a 3% volume growth. So clearly ITC cigarette volume growth is ahead of that. So that is coming because of market share gains. Similarly, in the FMCG business this year, because of the commodity meltdown, we should see margin expansion. So yes, the leftover ITC, which is the main business, 85% of the profit, and clearly the market cap also comes essentially from the non-hotels, that return ratio will clearly improve. and this has been a key concern. But I don't think the hotel demerger should be seen as a precursor for the demerger or value unlock of other business, because hotel business had its own issue of very high capital requirement and very high volatility in business because it is cyclical and low return ratio business. Rest of the other businesses, if you see, don't really have this kind of issue which hotel business had. So that is one thing which we also need to note.
Thanks very much for giving us that clarity, Avnish. Good to have you on board. We'll be certainly watching out very closely for ITC in today's trading session. All right, it's about 9:02 on the clock. Let's check in as to what the pre-open rates are indicating, and it is holding out in the green for now around the 19,800 mark, inching towards those levels as the Sensex is in the green. Let's find out those mid-cap strategies. What is it that our chartists are placing their bets on? Naresh?
So that would be a buy on care ratings. The stock has interestingly, slowly and steadily started moving up. Has gone through a sideways consolidation right from the time it saw a correction in COVID. The highs pre-COVID was around 700, 720 levels. Then in 2021 also similar. And now finally it is crossing that 700 to 750 mark. Slowly and steadily, almost a 3-year breakout in the making here. Once this breakout is done, expect a target price much higher than the near-term target price of 850. Looks very promising. Stop loss to be kept at 720.
Okay, that's care ratings for you. And Kunal, what's looking good within the broader markets?
Well, I would go for a buy on Parag Milk. That's a stock. In fact, many of these dairy stocks have done reasonably well in the last 4-5 days. These stocks have risen up somewhere in the tune of 15 to 20%. And over the last 3 to 6 months, many of these stocks have risen up by a margin of almost 50 to 70% for themselves, which means the momentum is in favor of these names, even in the short term as well as on the medium term charts. So would suggest a buy with 170 as a target, stop loss to be kept at 153.
Okay, let's take stock of some of the stocks which are buzzing around in the pre-open session. Pull up the SJVN stock. That's showing that it's going to start with a green tick. This is a development of 50,000 crore that they're likely to do with the Arunachal Pradesh government, and that is holding up with a gain of around 5%. JK Paper, a result candidate, is also showing a gain of around 5%. On the losing side, Shopper Stop is the stock on our radar. A cut of 5% is what the pre-open rate suggests, and ditto for Bata as well as TCM Shriram as well. But what is the stock which is making rounds in the dealing room? Let's go across to my colleague Sharad. He's joining us with the khabar on IFB Industries.
Well, yes, in focus we are having IFB Industries and the engineering division that is expected to get an EV order in the coming days. Now, apart from this, also the company is looking out for acquisitions coming in, especially in the engineering division, and the company has been focusing on the localization and the two-wheeler part of the EV segment. Now, this is for the engineering division. Now, important thing is that the key customers for this segment include Maruti, Tata Motors and Hero MotoCorp. And the stock itself, if you look at it, that's jumped 19% from March lows, and Equirus has a maintained buy rating with a target price of 1,221 rupees per share. But there are certain important recent triggers which are important to track, and the first thing is that the commercial production of the washer motor manufacturing that is expected to be completed by next month itself, and for the AC manufacturing motors, that line is expected to have their commercial production start by the month of December. Now, apart from this, also the management has been bullish on a turnaround strategy coming for the steel division.
All right, thanks very much for giving us that khabar. Let's move right on and revisit the stocks on the editor's radar. You've got auto stocks in the spotlight, in particular Tata Motors. Find out Nikunj's take.
Look, I mean, the auto sector has seen its best first 6 months in last 9-10 years. So obviously it is turning out to be the sector of the year. What has changed for autos? I think somewhere they did not participate in the post-COVID rally. Margin concerns were there in 2021, and in general the industry suffered because of semiconductor problems. And the global companies, they had the issues largely because the European economy last year, because of what happened to Ukraine and what happened in Russia and Ukraine, was in some kind of influx. Tata Motors numbers are due. Now everybody would be monitoring these three things: JLR performance, free cash flow and margins. On free cash flow, they've already given a guidance, so you know which way things are moving. JLR performance, you know that it's incrementally getting better because you get the auto dispatch number. This is the surprise. So if you're looking at the stock now, the surprise element really has to come from the margin front and also what is really happening to the domestic CV business, because that's where they've lost market share both in the CV market and in the HCV market. So I think Tata Motors will be remembered as a classic turnaround story. But if you're a near-term investor, you got to ask yourself what's next. You know, this what's next, I think, is the most important thing you got to ask yourself every time when you're looking at the numbers. These are the expectations, both sequentially as well as quarter on quarter. But for me, the monitorable here would be JLR margins and what happens to the CV business. We don't talk about it. CV business and what is happening there. Cash flows becoming better, JLR becoming cash flow positive, company migrating towards becoming a net debt. The Tatas, I think, have done a great job in turning around Tata Motors. I'm not taking that away. But in the near term, when you're looking at a stock, especially in terms of positioning, extremely overbought, little bit of disappointment could backfire like it did in a lot of other cases.
Okay, so watching out for Tata Motors, but what are the index calls coming in from our chartists today? Let's take a look at what they are saying about the Nifty. Kunal believes that there's still some buying opportunity there. Duresh believes that it's better to just stay away from the market, no trade zone, and Kushbora as a whole. So there's no consensus view today. There is three differentiating view coming in for the Nifty. For Nifty Bank as well, Kunal Bothra is saying that there's no trade, so stay away, whereas Naresh as well as Kush believe that there is a bit of a possibility to hold those positions that you have. So it's a hold coming in for Bank Nifty.
Alright, so let's nail it down to perhaps what really should be the ideal strategy if you are long. So Kunal, if someone's long and someone's participated, summer has become monsoon, time to change the strategy, take 15-20% off the table.
Yeah, from a trading play, definitely. I think more than 20-25%, maybe more than 20-25% as an average. And again, depends on which kind of stocks you have in your portfolio, how they have performed. If you have high beta stocks, for example, and especially oriented towards mid caps and small caps, I think the proportion of profit booking should be at least more than 40-50%, if not more. And again, depending on the quality of stocks, the percentage profit booking should be done. We are definitely hitting some sort of a peak in terms of many indices, not just Indian markets. So I think in that regards, there should be a major pause which should combine to the index.
Let's look at the trading strategy, and I'm going to get Kunal and Naresh both comment on it. I mean, something which we've just identified. Is this the ideal strategy, and our experts agree with that or not? That trading strategy graphic. First, start reducing your longs. No, not the Nifty call, the trading strategy right at the top which we identified. First, start reducing your longs. Second, do not commit any long positions or do not commit any fresh capital to mid and small cap stocks. That I think is very important. Reduce your commitment to long positions. Do not sell your portfolio, but avoid small cap stocks. Would you agree with this? The last two, reduce commitment to long positions.
Absolutely.
Don't sell your portfolio, delivery nahi bechna.
Correct.
But don't commit more capital to small caps.
No, I've not said delivery nahi bechna, but reduce your positions. What happens, Nikunj, is that when the move starts to be initial and gradual, the confidence is more to a large cap name, and when we enter into some sort of an excitement in terms of the phase, the money gets more tilted towards mid caps and small caps. So I'm pretty sure and certain that most of the portfolios right now would have more mid caps and small caps as compared to what was maybe at the start of the April month. So I think that's where one has to take cognizance of, reduce those number of stocks, because if the market corrects sharply, in case if it happens, then the correction in these mid caps and small caps could be severe.
Suresh, reduce commitment to long positions, take like 15-20% profit off the table.
So my view is, say if there is leverage, reduce leverage in a big way. But if it is purely a position which you are writing, the best way to write is to continue to write. So holding on to positions, do a churn in terms of stocks which have overmoved. Say for example, some sectors which have gone up one way, something like defense, etc. So pull money out of that, put into other defensive places. So the view is churn, not to pull out money so easily, because that's the best way to ride the trend, and that's the only way one has been able to ride it from 70,000.
Alright guys, 1 minute, and it's an important day largely because of autos. But where is the leadership in the market? HDFC Bank merger gone through, Reliance demerger, Reliance price discovery of Jio Financial Services, that's over. ITC demerger has been announced. ICICI Bank numbers, Kotak Bank numbers, the cat's out of the bag, if I may use the word. So where is the next trigger? Could it come from L&T, which is a 3% weightage? Could it come back from IT? Highly improbable. Autos cannot drive that. So if the largest contribution this year has come from ITC, well, the trigger is out. ICICI Bank numbers are out. L&T numbers due today. Reliance, already it's been addressed. And HDFC Bank, the merger has gone through. That's my only, not concern, but my only admission here, only submission here is that this market now needs a new leader. And I don't see anything happening in the top 5, which will give just a lot of momentum, so to speak. First rates on your screen any second now, literally any seconds now. First rates will just start coming up on the screen, and the first rates on your screen at the bell, right with the word go. 56 points higher for the Nifty. The market breadth is looking phenomenally strong, which is a surprise. Hero MotoCorp is on a tear. Another 40 rupees higher for Hero MotoCorp. Sun Pharma is looking strong. Nestle is looking strong. Tata Motors is looking strong. So autos are off to a good start. So we are pretty much starting from where we left yesterday, even though the market has seen a gradual decline of about 300 points, but there's nothing very sharp. ITC, the downturn continues after yesterday's massive sell-off or massive reversal. And for Hero MotoCorp, our technical experts were just alluding to that fact that where things are moving higher. SRF is down and out. Numbers were not that great. And if I have to mark some more stocks, say TVS Motor is bouncing back. So autos are in fine fettle. ITC is looking slightly rusty, and Nifty is off to a okay start, but mid cap is where the excitement I think is there, especially in Hero MotoCorp.
Well, yes, in the mid-cap banking space as well, it's the PSU banking index, which is the top sectoral gainer right now. Remember, it had hit a 12-year high yesterday, so that continues today as well. You also have some real estate stocks which are doing well. So Lodha, DLF, they have started on the front foot. It's only FMCG which is on the back foot, led by the decline that we are seeing in ITC. But in terms of stock-specific action, watch out for SJVN. That stock is perking up 10% after that tie-up that has happened in Eastern India, and they are building up almost 50,000 crore worth of project. JK Paper is a result candidate, 4% higher. Aarti Drugs, that buyback support and a good set of numbers after that 16% rally today, is higher by 4%. Torrent Power as well, wherein they are setting up EV charging stations in Ahmedabad, is also started on the front foot. KPIT Tech will report numbers today. Ahead of that stock is fairly excited, has opened up in the green. Let's talk about the laggards then. DCM Shriram, clearly it was a weak set of numbers and the street is punishing that. It's also punishing the likes of Sharda, Cropchem, etc. Remember, Bayer has cut down their guidance, and for the entire chemical space, and of course the fact that SRF numbers were weak, it is having a bit of a rub-off impact. MRPL, Shoppers Stop are some of the other names which are in the red. So clearly, with respect to the market, it's an okay start. We are at 19,700, but the market breadth continues to be quite stellar. And in terms of the sectors, it's PSU Bank, Realty and Metals which are charging ahead.
Indeed, within those pockets, you have quite a bit of fervor, and within the broader markets as well, lots of names standing out, SJVN, Torrent Power, as well as EIL and SEAT among the lot. Let's find out what our chartists make of the move. And Kunal, your thoughts, the fact that you said that as of now, it's time to take that little break, perhaps book profits. Is that the strategy that one should be adopting, and what should be the first trade that you're punching in?
So the opening is as per expectations. I was not expecting too much of a flurry. I think even though the pre-open was showing 0.5% to 1% kind of an upward take, but I was expecting a more flattish opening, especially some muted opening for the Bank Nifty. In terms of opening stock, I would believe Sun TV could be a stock which could be looked out for. So we flagged off this trade sub that 500 levels. Now even at 535, 540 where it's trading right now, looks attractive for another 10 to 15 rupees on the upside. So 555 could be a target. And with that time frame, would suggest Avanne Sun TV.
Okay, Naresh, what's your outlook on the market open this morning, and what is it that you're looking at by way of charts on your first trade?
So decent open on the markets, time to play defensive, and those are the stocks breaking out. So NTPC is the one which looks closer to a breakout towards the new 52-week high. So that is where I expect a move towards 210. So that would be a buy for now.